Welcome to the first of a monthly series of presentations to discuss SDCL Energy Efficiency Income Trust, or SEEIT, what the investment company does, what it does different, and the investment opportunity associated with it. I'm very pleased to be presenting today Jonathan Maxwell, CEO and founder of Sustainable Development Capital, also Corby Sapri and Toby Richardson on the fund management team. SDCL has been the investment manager of SEEIT since its inception. SDCL manages just over $2 billion of investments. We've been making investments in the energy efficiency sector as our specialization. We've been in business since 2007, and over the last decade or so, we've made over 50 investments. We've exited nearly half of them through portfolio or project sales or refinancing. So we've got a very high degree of experience of developing, investing in, owning, operating, and even exiting and refinancing projects. SEEIT itself was the first listed investment company to focus on energy efficiency on the London Stock Exchange. Moving on to the first slide. So the question we ask here is, what is the problem we're trying to solve? What's going on in the energy system and how can we improve it? And what makes SEEIT different is its focus on energy efficiency, the acknowledgement that one of those extraordinary features of the energy system is that so much of this highly valuable commodity that's generating climate change and economic stress, so much of it is wasted. So the extraordinary feature is that a lot of energy gets wasted even before it gets to the point of use. The diagram here illustrates where that happens. A very large amount of it happens before it even gets into the diagram. About 10% of energy can get lost through the extraction and conversion of energy into the system. 80% of the energy system today in the world is still oil, gas, and coal. But even when it's generated, generation process itself generates not just electricity, but for example, with gas or nuclear fuel, generates heat. And if that heat isn't being used, which it's very difficult to do if it's being generated centrally. If that heat isn't being used and it's very far away from the point of use, it's simply lost or wasted. And overall, in thermal energy centers, around half of the energy gets wasted at that point of generation. It's extraordinary. Then energy comes out of power plant, for example, and gets into town to the point of use, and more energy is lost on the way, another 10% lost in the transmission and distribution system. So the extraordinary feature of the centralized energy networks in Europe and North America, for example, is that so much, up to 2/3 of the energy is actually lost before it gets to the point of use because of the centralized networks. There are solutions to those problems, and SEEIT's portfolio attests to what we can do as investors and developers to put projects on site that cut those losses and improve the cost efficiency, carbon efficiency, and reliability of supply. But there's another problem on the demand side. Even when energy's got to the point of use, or what remains of it, energy then can be lost by or at the point of use. So a great example would be in buildings, which are some 40% of energy use in Europe. If they've got the wrong lighting, heating, ventilation, air conditioning, then the energy is not being used efficiently. In fact, sometimes 10, 30% plus can be lost. It's the same in industry, for example, with motors, controls, industrial processes. It's even the same in transport with petrol versus electricity. So on the demand side, figuring out how we can replace infrastructure, mechanical and electrical infrastructure inside buildings, industry, and transport, which after all is where 70% of the world's energy used. That's where we can make a big difference. And SEEIT's portfolio comprises solutions to these two problems. It generates energy on site, so it doesn't get wasted on the way to where it's needed. And it invests in projects that reduce the amount of energy at the point of use. And Corby will take us through case studies of how the project investments work and how we make returns out of them. If we can move on to the next slide, please. Here, the fundamental question asked, why? Why? Okay, if energy is being used inefficiently in the world, so what? Well, here's the so what. There are sort of four key problems with that wasting energy. The first is cost. Energy is incredibly valuable. It costs a lot of money. And in a high energy price environment in particular, as we've seen, particularly over the last 2 or 3 years on the run up to and then in the aftermath of the Russia-Ukraine crisis, enormous levels of volatility, but we've been dealing in a relatively high energy price environment in the UK, parts of Europe and America. So reducing the amount of energy that's either wasted on the way or used at the point of use costs less. And it's an extremely important way of getting economic productivity in, not just for countries, but for companies. So cost reduction is the first answer to the question, why do energy efficiency? The second is availability or energy security. So building energy systems on site instead of relying on the grid provides a more resilient infrastructure for the end user. If the grid goes down, it doesn't matter as much. You've got energy being generated on site. That's extremely important in a local context for data centers, hospitals, any type of critical building or infrastructure. But if we zoom out on a national scale, of course, energy security has been headline news in Europe, at least since Russia's invasion of Ukraine. And it's been a huge feature of the way that the US market around decentralized energy has developed because of extreme weather events knocking the grid off. So energy security is a really important piece of this. A third pillar is really around climate change. If you're using energy, but you don't need to use as much, then you don't need to generate as much, or at least you can do more with the energy that you were generating already. That's what efficiency really means, doing the same or more with less. And that has, as we've described, huge cost benefits, but it's also the largest, fastest, cheapest, and cleanest source of greenhouse gas emissions. So if we're focused on mitigating climate change, being energy efficient is actually the largest and fastest solution, certainly to near-term 2030 targets for decarbonisation. And the International Energy Agency's report in November last year attests to that. Energy efficiency can deliver, they said, 50% of the 2030 carbon emission reduction targets. The last point about why is a feature of the first three, in a sense, because of cost, carbon, and security benefits. Policymakers around the world have really started to ramp up their focus on energy efficiency. Actually, the COP28 Dubai Agreement was the first time the United Nations calls to all countries have prioritized energy efficiency alongside renewable energy as part of the decarbonisation plan. But there are specific regional policies which are now really leading the pack. The US Inflation Reduction Act has put up about 20% of the $370 billion of stimulus going into the clean energy market to focus on energy efficiency. The EU has a policy of energy efficiency first within its Green Deal industrial plan and around it. And even in the UK, we have policies like Powering Up Britain. So in conclusion, cost, security, carbon, and now tailwinds from policy support around the world, because energy efficiency is the fastest and cheapest, cleanest, and largest source of greenhouse gas emissions and economic productivity growth. If we could move on to the next slide, please. How does SEEIT relate to all of this? It tries to bring these themes together into an investment vehicle that can translate the concepts into investable projects and generate returns for shareholders. Returns in the form of income with progressive dividend growth, and also capital preservation and capital growth going forward. In terms of the way that that's put together, the company is listed on the main market of the London Stock Exchange. It's a FTSE 250 investment company, which provides investors, whether they're retail or institutional, the opportunity to buy and sell the stock openly on the premium segment of the London Stock Exchange. When they're buying into SEEIT, they're buying into a massively diversified portfolio. It's diversified by geography. Nearly 60% of the portfolio is in the United States, and around 20% in Europe, 17% in the UK. And the portfolio is diversified by, as Paul will come on to, by geography, by technology, by underlying counterparty. So it offers a tremendous depth and breadth across the range of opportunity sets. Second point, as we're coming into this point of the cycle over the last year and a half, inflation obviously has been higher than most countries would have wanted or even imagined. We do have in SEEIT, having said that, a positive correlation with inflation. Our revenues overall go up when inflation goes up. So there is a positive correlation in terms of our performance. We've been conservative with the way that we structured the gearing in the company, not just in terms of its short-term, but also its medium to long-range gearing targets and limits. So we have a moderate gearing and therefore a strong balance sheet. The pipeline within the business of the portfolio is also quite unique now. We started life in 2018 at a smaller size and built up the portfolio over the course of the last few years to a net assets of over £1 billion, and including the project finance, nearly £1.5 billion. What that's doing is also though creating its own, or what we call organic pipeline. So investments that we've made already then lead on to additional follow-on projects as projects expand, as contracts can be signed with additional counterparties. And it gives the company not just critical mass and diversification, but also a natural deal flow to continue and invest in its underlying projects at attractive rates of return, where it's feeding new capital into existing arrangements, often with rights of first refusal. The company's total return focused. Yes, it's got a very high level of income and cash flow, and therefore a dividend relative to a lot of the peer group. But we're also very much seeking to expand the revenue that we're earning from our underlying projects by expanding capacity and improving margins. And within that context, it gives us the opportunity to achieve not just relatively high levels of income with progressive dividend growth, but also capital growth going forward. We've identified in our report and accounts where we think those, and we know those capital gains opportunities are, and how we're performing against certain milestones. And then the last point I'll come back to is the strategic point around energy and climate. As I've said and explained, energy efficiency is a very important part of the decarbonisation trajectory. While the bulk of capital markets and investment time and policy for the last 20 years has gone into new renewable energy generation for the grid, which we celebrate, at the same time, given that so much energy is being wasted in the system in the first place, we feel that the same or more amount of time, effort, and policy and investment should now be going into saving it rather than just generating it. If we can move on to the next slide. So I'd like to hand over at this point to Paul Sapri, who will take us through the portfolio characteristics.
Thank you, Jonathan. My name is Paul Sapri. I'm the fund manager for SEEIT, and I wanted to take you through the next few slides where we will give you a bit more detail around the portfolio construction for SEEIT and what brings together the investments that we've made over the last few years. There are three layers to how the portfolio has been constructed in SEEIT. Starting with the first one is the investments that we made must fall within the definition of energy efficiency and the problem we're trying to solve. Jonathan has talked about in detail what the problem is and how they can be solved. And each of our investments must fall into three categories, which we've detailed on this slide. The first category is cleaner and more efficient supply. By this, we mean bringing the energy generation closer to the point of use. A great example of this that everyone will be familiar with will be solar projects that are on the rooftops of buildings. So rather than relying on a solar project that is far away from the building that needs the energy, we have invested in projects through Onyx with rooftop and adjacent projects that are directly connected to where the energy is needed. And as a result, reducing losses through the transmission and distribution of energy. The second criteria that falls within energy efficiency is point of use demand reduction. And by this, we mean reducing energy at the point of use. This is something that individuals will be very familiar with, and it's making the buildings themselves more efficient. Examples of this is our investment in Future Energy Solutions, which is in providing lighting as a service. So SEEIT has invested in energy efficient light bulbs across a number of customers across the US. reducing the energy consumption for those buildings themselves. And finally, the third category is green energy distribution. Here, the investments are connecting supply with demand in the most efficient way compared to alternative solutions. And a great example of that is district heating and our investment in Red Rochester, which is providing multiple energy services on site for over 100 customers. Moving on to the next slide. So the second criteria for SEEIT's investments is the business model. We've talked about energy efficiency and how it's connected to the end user. And this is a key difference between SEEIT's investments and a lot of other renewable investments, in that our assets are not connected to the grid, but to an identified end user, and the investments themselves are connected to those end buildings. The business model for SEEIT's investments are similar across all the investments we've made. Typically, what we have is an asset that is owned by SEEIT. This could be lighting, it could be cogeneration, it could be solar. That asset is providing a service to the end user. So, for example, solar as a service, lighting as a service. This service is provided over the long term through a contract, giving good visibility for revenues for SEEIT's asset. In terms of costs, there's very good visibility. SEEIT typically does not take any unmitigated commodity pricing. This is passed through either to the end user or is hedged. Other costs, such as fixed overheads, which is typically labor, or variable costs, which is a small portion of the overall cost, can be identified and are visible over the long term. As a result, you do have long-term visible revenues, long-term visible cash flows, resulting in long-term visible net cash flows from the assets to SEEIT, which supports the strong dividend and cash flow generation for SEEIT. Moving on to the next slide. The third characteristic of SEEIT's investments is the opportunity for total returns within the portfolio. These are more prevalent in certain assets, in particular the larger ones, as well as the development platforms such as Onyx or EVN, where SEEIT has access to proprietary investment opportunities at typically higher returns. The track record of the development vehicles themselves can drive value, which SEEIT might look to crystallize in the long term. The other upside opportunities is through operational improvements, whether this is through unlocking new revenue streams with existing and new customers, or efficiency improvements through reducing costs. All of these support the total returns objectives of SEEIT. Moving on to the next slide. The portfolio can simply be represented as 6 businesses, which make up the majority of SEEIT's value. We wanted to show you 2 videos of 2 of our favorite investments within SEEIT. We'll start with Primary Energy, which is located on the shores of Lake Michigan in the US.
Mo Kluffiker, president of Primary Energy. I have 30 plus years of experience in the energy sector here in the U.S. Primary Energy consists of 5 projects. Clean energy is produced utilizing waste energy from 2 major steel mills. One is Cleveland Cliffs. They own the Indiana Harbor Mill, where 4 of our projects are located. 2 of them utilize blast furnace gas. The blast furnace gas is reused in a boiler, produces steam, and that goes to 2 of our projects, North Lake and Ironside. Our 3rd project is called Coke Energy. That utilizes waste heat. The heat is collected from 268 coke ovens, is then put into a heat recovery boiler. Steam and electricity are produced, which is utilized by the steel mill. So there's no fuel involved. Our other project over at U.S. Steel is Portside. It utilizes natural gas. It produces steam and electricity. We also produce all the water products needed by the Midwest facility. one of the biggest benefits that Primary has in its relationship, it's really its partnership with the steel mills. We provide the management. We obviously own and operate the facilities, but the operators, they are steel mill employees. So the sort of the benefit that we have provided to the steel mills over the years is we utilize their employees. The business plan for Primary Energy is really built around long-term contracts. The benefit of our contract is really the stability of the cash flow coming into our business. We are the big E in ESG because of the efficiency, but also because of the environmental benefits. We reduce the CO2 emissions because we're utilizing waste energy. And if you think we're behind a meter, we're integrated right into the mill. As far as delivery of that energy, it doesn't get any more efficient because we're on site. The one thing that we tend to follow with both steel mills, US Steel and Cleveland-Cliffs, is their sustainability goals. We have identified a couple of opportunities looking at new technology associated not just with efficiency, but also in CO2 reduction.
And the next video we'll be showing you is SEEIT's investment in Onyx, which is a solar developer of on-site rooftop and projects across the US.
My name is Mary Beth Mandanas. I'm CEO of Onyx Renewable Partners. Onyx is one of the most established distributed clean energy providers in the United States. The main product and service that we offer is solar and storage. So we take it from the engineering to the pre-construction, and then we are overseeing the construction. But we outsource for local construction companies. So it's on site, and we sell the renewable energy as a service back to the customer. This helps them solve not only some of their sustainability goals, but also it provides an economic savings. Our market is actually uncapped. We do all kinds of commercial enterprises, all kinds of industries. We work with schools, municipalities, and the military. Our geography is nationwide. We've operated across 27 states. We have over 300 projects. We understand utilities, we understand construction, we understand engineering, and our asset management team has been managing the same assets for almost a decade. We currently have about 50 employees, and about 60% of those employees are in customer-facing roles. We provide a service. The customer is the most important. What I want us to create at Onyx is a very diverse and inclusive culture. Onyx's key differentiations really about the team on the field. We have one of the best teams on the field, I think, in the industry.
My name is Buck Fletcher. I'm the Chief Financial Officer at Onyx Renewable Partners. The Onyx business model is straightforward. We enter into long-term contracts with our clients to deliver clean energy projects on their sites. It's a relatively predictable revenue stream over a period between 15 and 25 years. We certainly see it as a long-term service to the customer, and this aspect of our business helps us and our clients benefit from economies of scale. And it gives us the opportunity to deliver potential new solutions to them as the distributed energy landscape continues to evolve.
Onyx is in the right place at the right time. It couldn't be more perfect. We've got tailwinds related to the climate, related to energy resiliency, related to the need for energy redundancy. Our on-site solutions provide and meet all of those aspects. Onyx Renewable Partners is the one-stop shop. We design, we develop, we build, we own, and we operate the asset for the long term.
Other things that we'd like to point out is the majority of SEEIT's investments are operational, around 80%, which again supports the long-term cash cover and cash generation for SEEIT. There is an exposure to construction and development, which does provide opportunity for upside. The other point we want to bring out is that the majority of SEEIT's investments is in the US, which does have relative attractiveness in terms of macroeconomic and policy tailwinds. With that, I'll pass on to Toby for the next slide.
Thank you very much, Purvi. My name is Toby Richardson. I'm a senior director in the team at SDCL, and I'm engaged in supporting SEEIT's fund management function. I'm going to talk to you about the financial results of SEEIT, which reached its 5th birthday last month. Since its launch in 2018, with a portfolio of 100 million, it's grown significantly to over 1 billion in asset value. This growth has been delivered through investments which have been funded through the issuance of new shares. The two most important KPIs for investors are the net asset value per share. This is the value of a SEEIT share, which is implied by an estimate of the market value of the portfolio of the investments and adjusted for debt and working capital within the SEEIT investment vehicle itself. And the other important KPI is dividend yield, which is funded by cash from the portfolio and therefore is an important demonstration of the value within the underlying investments. The valuation of investments is undertaken by SDCL and is primarily based on discounted cash flow techniques. This means that the valuation is a function of the outlook for cash generation from its portfolio of investments and an assessment of the market's appetite for those projected cash flows, with a view on the longevity of those cash flows and the risk associated with them. Evidence for this appetite is derived from comparable transactions in the market, to which SDCL brings much insight through its market presence, but also benefits from support from a third-party specialist who bring their own perspective to it. The annual valuations are subject to scrutiny and challenge of SEEIT's auditor, and the independent board who sign off on them bring their broader perspective too. Since its first full reported year, dividends have grown more than 20%, and the dividend cover from cash has remained consistent in the company's history, with the cash flow continuing to grow period by period. In this full year coming, the dividend cover is expected to show an increase on the 1.1 times, which was achieved for the 6 months to September. In the past 18 months or so, SEEIT, along with much of the listed income market, has suffered from the significant upward revision in interest rates, which have translated into higher discount rates and put pressure downwards on valuations. Nonetheless, the fundamentals behind the cash flows remain, and outlook for a well-covered dividend remains robust. And with that, I hand back to Jonathan to conclude the presentation.
Thank you, Purvi and Toby. There's a significant opportunity today for new investors in SEEIT because the shares price is trading at a substantial discount to the net asset value, and because at today's share price is a very substantial dividend yield on those shares. In fact, the net asset value is over 50% higher than today's share price, and the dividend yield is over 11%. In our interim results, we disclosed a 5-point plan for us to close that discount and help to improve the share price relative to net asset value. The first point of that plan is pursuing disposals to raise cash, to reduce our gearing, potentially to fund buybacks, and to recycle capital from lower returning assets into higher returning assets, improving the total return profile and performance of the portfolio as a whole. The second point of the plan related to our capital allocations policy, focusing investments on opportunities coming out of our organic pipeline where we already own and know the portfolio, where we have rights to invest in follow-on projects and where they can meet minimum return hurdles, which are attractive as a return on invested capital. Third is about listening to our shareholders, listening carefully to feedback, planning our actions accordingly, and making sure that that engagement continuously improves our understanding of shareholder requirements and their understanding of how we're operating the company to their best advantage. The fourth point is about promoting SEEIT shares, improving the marketability and liquidity of its shares, talking to investors that we have already on our register, but also talking to investors that we don't have on our register from the UK and other international markets, particularly given the attraction of the share price relative to net asset value and given the dividend yield. The fifth point is about delivering on accretive projects. This is where we've got real opportunities for performance, not just to drive our income and our dividend yield going forward progressively, but also to unlock opportunities for net asset value uplift and growth going forward. If we move on to the next slide, in conclusion, today, at the current share price, SEEIT shares represent a compelling capital gain opportunity as well as an income opportunity. There's a capital gain opportunity because of the potential growth in the share price relative to net asset value, as well as the longer term prospects for net asset value growth. There's an income opportunity because of a sustainable double-digit long-term yield together with a progressive dividend policy. There's an opportunity to invest uniquely in energy efficiency projects as an asset class. SEEIT was the first, and today is by significant margin the largest investment company of its kind, focused entirely on investing in energy efficiency projects, the largest, fastest, cheapest and cleanest source of greenhouse gas emission reductions, security and productivity. The fourth point is around diversification. Over the years, SEEIT has built up a very large, highly diversified portfolio by geography, technology and counterparty, which provides opportunities for growth as well as protection of value on the downside. The balance sheet is in a strong position because it's got relatively conservative leverage, both in terms of its targets and its limits. The overall portfolio is positioned to deliver a total return, so a combination of capital growth and income. And on the income side, it's called the Sustainable Development Capital Energy Efficiency Income Trust, PLC. Income is a key driver of our investment objectives, and we continue to seek to deliver progressive dividend growth going forward. So with that, I thank you very much indeed, and thank the team, Corby and Toby, for presenting with us today, and look forward to questions.
So we're inviting questions from the audience. Yeah, please let us know what you've got.
I think there's one question coming in right now, actually, on the platform. Just wait for that to come through. Mentioned provisions on some of the USA assets. What's the position on these, and is this spooked the market? Maybe Paul, you can join in on this one. It says in the I think this is from one of the investors. In the last presentation, it says you mentioned provisions on some of the USA assets. What's the position on these? And there's a subtext question, which is, has this spooked the market? So we published our semi-annual results in December for the period ending the end of September. At that point, we reflected where our portfolio is, where we stand today, where we stood then and where we are now is broadly across the portfolio. Paul, we've got stable performance.
Yes.
in the report and accounts, we put out some data related to how we were tracking on revenues on Red Rochester during a period of time with some seasonality because of the weather affected the thermal output we were generating for a period. From time to time, we do get some seasonality in our revenues, but I would say overall, we're comfortable with the long-term performance of our assets. They're operating well. They're generating for the full year so far. We're on track for our key metrics in terms of cash generation and earnings. So although we try and provide as full disclosure as we can, I don't think there's any reason for the market to be unsettled on that. Probably any points that you wanted to raise?
No, I would say, as Jonathan mentioned, that's quite correct. That's a good summary of what has happened in Red Rochester. A lot of the provisions that were made, we are actively and have been since we've made the announcement, working on unwinding those. They take time. We're looking at tariffs, contracts, capex, accretive projects, bring them forward. All of them take time. But that's something that is focused for not just the manager, but also on the management team on the ground. And it will be over the next few periods, we should be able to, or we expect to realize that.
There's a second question, which is about, it said in the opening remarks, we refer to capital protection and growth. That relates to the underlying portfolio value. The question actually is, it says, so why has the price been suffered? In fact, the precise question here, phrase is a little bit more pronounced than that, but why has the price corrected as far as it has? Now, there are a couple of features here. One has got to do with reflecting valuation. At the end of September, our net asset value was adjusted down to reflect largely a macroeconomic environment with a peaking of interest rates recently in the autumn of last year. So we took a very substantial reduction in NAV through. That's an unrealized position. And in fact, as we all know, long-term rates have recovered somewhat since that point in time. So there was an element of macroeconomic adjustment. Having said that, the investment trust sector as a whole, and very broadly the income sector during the course of last year and coming into the beginning of this year, has had significant challenges. We've seen, we've observed, outflows from mutual funds, which have forced redemptions and therefore selling across quite a lot of the infrastructure space, particularly funds in the renewables and in our sector have been affected. SEEIT has relative scale and liquidity being part of the FTSE 250 index, and that works both ways. And sometimes we've seen additional selling coming through from our register because people can find liquidity. We believe that we have a very solid, and that relates to the next question, a very solid foundation for our valuation on our portfolio. And we think that there are some very strong opportunities for that to continue, not just to provide capital preservation, which was the point I made at the beginning, from a real underlying fundamental value perspective, but also capital growth going forward. We've identified very specifically in our last annual report and accounts, identified upsides that we are in the process of exploring and delivering. Hopefully you'll see some positive news coming out of us in the not too distant future related to a number of those initiatives. There's a question here about discount to net asset value related to share price, but also can we clarify when we plan to implement disposals, which would help us validate the net asset value and allow gearing to be addressed and potentially improve shareholder returns. The answer to that question is that towards the middle of last year, we were reviewing opportunities. Towards the end of last year, we said that we're progressing opportunities, and we are very much looking forward to the opportunity of coming to the market and telling the market that we will have achieved realizations, and that will, in our view, that will help to provide confidence and support around the net asset value for our portfolio. So we are highly confident on the net asset value, and we look forward to being able to demonstrate that through the selective disposals that we signaled to the market during the course of last year. It's very much our intention to achieve selective disposals and to look to, as we put out in our 5-point plan to reduce the discount last year, to use the proceeds of those disposals to repay gearing, to provide some flexibility on the balance sheet, and to perhaps start to be able to look at implementing share buyback programs again, if the share price remains at such an attractive discount to net asset value as it stands today. There's a question about what our brokers are doing to get the share price higher. One of the other points of our 5-point plan was about improving the marketability and liquidity of the stock. We've been talking to, we meaning the broker and the manager, have been talking to investors, not just inside the investment trust sector, but on a broader basis, and again, not just in the UK, but internationally, about SEEIT, the unique portfolio that it has, and the extraordinary discount to share price and cash yield, which is covered by our dividends are covered by cash flows, and we have a progressive dividend growth objective, which we're comfortable with. We've been having those conversations broadly. The broker has been very supportive in that, and again, hopefully we'll see a deepening of the market and a broadening of interest in SEEIT and stocks like it, candidly, just given the deep value associated with them. There's a question about gearing targets and what is the gearing target. That's a matter of the investment limitations that are set out in the formal documentation for the trust. Toby, do you want to pick up that question? But the gearing limit is, in a nutshell, 65% of net asset value at the point of acquisition. But we have medium-term gearing targets, which are around a 35% of net asset value.
Yeah, so just to reiterate, we have gearing at 2 levels in the portfolio. We have gearing at the trust level, and that is measured against net asset value of the trust, of the company, and the target that there is a cap of 65% there, and that permits use of an acquisition facility to add to the debt which is also underneath in the portfolio below. For the portfolio investments, we have a gearing target of 35%, and as we stand today, or as we stood at September, the gearing in the portfolio remained at that 35% of net asset value level. This, if it was measured against the EV or the LTV of the asset, would be 26%. So it's quite a conservative target.
That's at portfolio company level. Of course, at the investment company level, at SEEIT level, we have a revolving credit facility, and we use that revolving credit facility for short-term financing, and it's that revolving credit facility would be the first use of proceeds and disposals achieved in the first half of this year, as they are being planned. There's a question about disclosure of backlog of revenues or amount of contracted revenues by year going forward. I don't know, Bobby, if you'd like to take that question.
Yeah, so we've disclosed the level of contracted revenues. This is in our accounts, and we've done that historically. In terms of backlog of revenues, there isn't one. We look at the forecast. We have contracted revenues across the majority of our assets. As part of our valuation, we have long-term visibility on the cash flows of those or associated with those, which goes to our NAV. So there is disclosed or is incorporated within the NAV. And like I said, we at the point in time in which we have our valuation, we do disclose
of the total value, how much of that is actually contracted?
Yeah, and just also in a nutshell, probably if we look at all of our portfolio across the board, all of our portfolio has contracts in place for its revenue, and most of those contracts are on a basis which is predictable. In most cases, have availability style characteristics to them, and to the extent they don't, we have rights of first dispatch, which give us predictability going forward. We have a very limited amount of variable revenue under those contracts. There's a question about profit and loss, and a question about, which is interesting, about valuation. And I think that refers to the fact that we have unrealized gains and losses on the investment going through the P&L account. So happy to take any question about that offline. But we follow standard investment trust accounting processes and principles. There's a question about FX and interest rate hedging. I think on the FX hedging side, we've run a very successful FX hedging policy, which substantially brings our foreign exchange back into sterling, with the effect that it has very little impact on our net asset value in any year. We've been running the same strategy for 5 years substantially, and we've never had a deviation in NAV caused by FX of 1%. So it's always operated within that level, typically at around 0.7%. We have had broadly a similar sort of a heavy approach in bringing our foreign exchange exposures back into sterling, 90% plus hedging. We had a minor relaxation of that level during the course of last year, but it's still up in the 80s in terms of the overall hedging back into sterling, and the effect, because there's a reduction of cost associated with that, the effect on our net asset value has been negligible. So we still have been operating very successfully within a very tight range. This has been, in other words, substantially no impact on net asset value for changes in FX. On interest rates, we have, I think this is an important point. As Toby pointed out, most of our leverage in the company is actually down at project level, and is as well, in addition to that, fixed or swapped. So we have a very strong level of visibility on our interest rates at project level. By and large, the project finance is paid from free cash flow in the underlying projects, and is amortized over the life of the investment, or within the life of the investment. Most of those, all of those project finance facilities substantially were secured before the September 22 credit crisis, so to speak. So we do benefit from attractive levels of interest. And I would say the other feature that we've been looking at is, even on refinancing opportunities with some of those facilities are swap supportable. So it does give us a lot of flexibility on how we manage leverage at portfolio company level. The revolving credit facility is a shorter term facility, but we have applied interest rate caps and hedges around that as it's drawn. We have a question here about higher discount rate versus peers, and I'm just looking at the question actually. Higher discount rates versus peers have been cited by brokers. So I think this is an interesting point. We have historically just quoted our discount rates based on an unlevered portfolio discount rate. This time we disclosed a levered discount rate, which is about 9.5. But that, going back to what I said before, our project level gearing is relatively short term. It's about 4.5 years weighted average life, compared to a much longer cash flow profile of our actual underlying investments. So we also stated in the fine print of our latest annual report and accounts that if you were to assume that that debt was extended and continued to be refinanced going forward, the leverage discount rate would be closer to 10.5. We've applied that for prudence. The discount rates that we apply to our underlying portfolio are opined on by a third party. We put our discount rates in within a range. We think it's a prudent, potentially conservative and cautious approach to valuation. And that's one of the reasons why we feel that our net asset value is firm. And again, to the point before, that should be revealed in terms of disposal outcomes.
Yeah, there's another question which relates to a discount, but in relation to our share price discount versus our peers. And I think the question was here is that it's been cited by brokers due to a lack of disclosure at project levels. We took feedback from the market, investors, analysts in 2022 about wanting to get greater disclosures across all the assets. And if I can refer you back to the March 23 annual report, significant steps and a significant change in the level of disclosure was provided for the largest of the 6 assets across the SEEIT portfolio, where we provided metrics against which investors, analysts can track performance over the periods. They're annual metrics. We provided guidance as to where we expect those to land in our interims. And again, we will be providing disclosures against those specific assets in the upcoming annual reports, in where investors and analysts can also compare against the prior year. So again, recent reports, there has been feedback from the market that the greater level of disclosure has helped understanding the portfolio of SEEIT a lot better.
Thank you, Purvi. We have had positive feedback on our disclosures from financial year 23, and the answer is yes, we're going to continue to optimize and improve the way that we provide transparency and disclosure in the underlying portfolio. We're pleased with the portfolio, and we're very pleased to report on performance against targets. We have a question on why the company's made additional investments from the RCF since and in October 23, when the focus is on disposals and other aspects to reduce the RCF. The first point I'd like to make is a fundamental distinction between investments and in terms of new investments and investments in terms of providing capital against construction programs. So that's really the fundamental answer too. We have not continued to make investments at this point, which are new. We are operating in a higher rates environment, and there are potentially attractive investment opportunities out there in the market, but we are not progressing at this point with making fresh investments or M&A, new acquisitions in the marketplace. One of the reasons for that is obviously the balance sheet, and we don't want to draw on RCF to do that. At the same time, we do have within our portfolio projects that are under construction. So we have been feeding capital in to fulfill those construction programs, which represents the core value of our underlying portfolio as far as those assets are concerned. So for example, we have been drawing down to fund the construction processes for the solar on-site solar projects in the United States with Onyx. And as another example, we have a program of fast charging EV stations, one of which the Chancellery Exchequer opened in the autumn in Birmingham. So as we've made part of our portfolio and frankly part of the total return delivery capability of SEEIT associated with construction projects, we're feeding a limited amount of capital into construction. We try to provide the market with guidance as to the limited amount of capital that we're going to be using to fulfill those construction commitments. But we are absolutely very limited in terms of our approach. We're not making fresh investments outside of the existing portfolio today. Our focus is on fulfilling those opportunities within our core portfolio, our organic pipeline within it, that are required and important to preserve and grow the value of our existing portfolio. It is limited, but we are nonetheless supporting those construction programs. There's a question about the risk of major investments in industrial installations such as steelworks, and talking about the financial stability of the plant in question. The answer to that is that we have two fundamental underwriting criteria when it comes to our counterparties, our credit counterparties. The first criteria is that we want the credit counterparties, or the obligors under the project agreements that we have, to be of very good and strong financial standing. That's why in a significant majority of our portfolio tends to be investment grade counterparties. However, there are some other counterparties within our portfolio that either are not investment grade, or frankly, even if they were, we have a second criterion, which is very focused on looking at what type of asset, in other words, what type of building, industrial facility or transport asset we're serving by providing energy. That relates to the following basic approach. We want to be an essential energy service provider to our clients, because that means that we are embedded in their organization. It's important to them that we're providing the services. And in most of these cases, our clients, and this is a big responsibility, but most of our clients can't do without the energy that we're providing to them. So we're an essential energy services provider to them. It makes our relationship symbiotic, but we also want our clients to be essential to their economies. And this actually relates quite well to the steelworks question. And frankly, the other major projects in our portfolio have the same characteristics. We were very specifically focused when we made our investments in Indiana on the fact that the largest driver of revenue for us in those projects, in the steelworks, in primary energy that the question refers to, come from Blast Furnace 7. It's in the top quartile. It's always been at the top or the best blast furnace in the United States from a profitability, productivity perspective. It's also of national strategic importance. It's providing a certain type of hot rolled coil into part of the US market, both public and private sector, which is very difficult to displace. In fact, doesn't get displaced. A great example of how this has come to roost for us was during COVID, which was a systemic challenge, not just for credit, but for operations of industrial commercial facilities all over the world. When governments were shutting down business, they couldn't and didn't shut down the steel mills like Blast Furnace 7, nor did they shut down agriculture, for example, in Spain with our projects in Oliver. So I think that second underwriting criteria, the first is credit counterparty. The second is, are we an essential energy services provider to essential industry? Because then whatever the credit standing of the owner, when push comes to shove and there's a real crunch, and COVID was a great example of this, our clients keep operating. And in order for them to keep operating, they need our energy.
I think we've finished our time slot, and we've also fortunately finished on the questions. So thank you very much for all of those, and thank you for your attention this afternoon.